Hello everyone and welcome to our simplified stock investment course. Today we are going to talk about how to identify the best stocks to buy. So here are the 5 rules that you will use to identify which is a good stock to buy. Rule number 1, buy a stock that has long-term prospects. The main aim of buying a stock is to invest in a company that will pay you profit. So the best companies are companies that will pay you dividends for the next 10, 20, 30 years. So you are always trying to find that company. For example, I'm going to give you an example. For example, you want to invest in a company. Then you look at the product. I'm going to use an example of plastics. You look at, you want to buy you want to buy shares in a company that makes plastics, but according to the news you've heard, plastics are not going to be needed in the next 5, let's say 7 years. Why will you go ahead and buy that company? So you try and avoid companies like that. Then another thing is, when you want to buy a company, you want to always look for companies that are making profit right now, but they show an indication of making profit for the next coming year, so that you don't have to buy and sell in a few years. Then next rule, buy a stock that is stable and predictable. Stability and predictability in this case will be measured in terms of assets. That's the first thing. Profit and price. So when we talk about assets, for example, if a company owns assets worth 500 million this year, then the next year they have sold off almost half of the assets. That's a company that's unstable. You cannot predict how many assets they will have at the end of 5, let's say 10 years. Then in terms of profit, if a company makes a large profit this year, next year they make a loss, the other year they don't make anything, they don't make a profit or a loss, then the other year they make a large profit, then the other year a loss, that's a company that's unpredictable. So you try to avoid such a company. Then last but not least, you look at the price. For example, if you find a company that is worth $10 today, then tomorrow they are worth $20, the other day it's worth 50. That's a company that fluctuates a lot, so you try to avoid such a company. But if you find a company that has small fluctuations, let's say the price ranges from $20 to $25, that's a realistic company that you want to invest in. So rule number 3, you buy a stock that's under good management. So it's very difficult to measure good management, especially for people who are just getting started with stock investment. But what I can say is that you can use 2 ratios to measure how good a management is. The first ratio is known as debt to equity ratio. We are going to look at it later. Then you look at the current ratio. So simply explain, the debt to equity ratio shows you how much of a debt the company has versus the the equity. A good company, let's before we get to a company, a good person, for example, if you are doing your financial planning, for example, let's say you have assets, you have equities, you have houses, land, whatever, you have assets worth 100 million, you should not take a loan more than 50 million. Another example, if for example in a year the amount of money you are making is, let's say 20 million, and you want to go ahead and take a loan, it's always advisable to go for a loan that's around 10 million. So the same thing applies to companies. A good company is a company that does not take a large loan that exceeds the amount of assets or equities they have. So to measure good management, a good management must always ensure that the debt to equity ratio does not exceed 0.5. Then next up is the current ratio. We have a ratio known as the current ratio, and the current ratio is used to predict the likelihood of a company making profit. So a good management must ensure that the current ratio exceeds 1.5. We're going to talk about it a bit later. Then last and least, the last rule you must consider before buying a stock is to always buy a dividend paying stock. A lot of people will question this, but I always think when you invest, you must always think about both the short and the long-term prospects. So a company that is growing, let's say the price is growing, is a company that's a good long-term strategy to look at. But dividend is a good way to, you are making money out of your stock, but at the same time, in the long term, the price is increasing. So it's always good to get stocks that will give you both short and long term benefits. So let's look at the rules in detail. So here is a story that I'll go through quickly. You can just read through, but basically it's the story of John who bought stocks worth 50,000. Then he held on the stocks for 70 years. But now, if he's to sell the stocks now, he can make 750,000. 750,000. So you look at a profit of about 700,000. So to put this clearly, stocks are a good investment, but they pay better when you hold on to them for a long term. So that's why a continuation of rule number 1, we say you should always identify companies that are making profit but show a likelihood of making profit for the next coming years. Then next on, we look at rule number 2, which we've discussed. Say buy a stock that is stable and predictable. Said avoid volatile stocks. Volatile stocks are stocks that fluctuate in terms of price, profit, and assets. I have an example here of company A, which is relatively stable. You look at the profit and they fluctuate, but the profit at the fluctuation is very small. But you look at company B, and 1 year they are making 45 million, the next year they are making 5 million. So you look at that fluctuation and it's not realistic. So try to avoid such companies that fluctuate a lot. Then rule number 3, a good stock must always be under good management. As I said earlier, you measure good management mainly by looking at 2 ratios. The first ratio is the debt to equity ratio, which shows how a company manages debt. We've said the debt to equity ratio should not exceed 0.5. When the ratio exceeds 0.5, the company will struggle to pay the debt, and it might end up going bankrupt and you lose your money. So try to avoid such companies. I've said the exception to this rule is companies involved in financial services. If you look at companies such as banks and so on, their debt to equity ratio is in most cases above 1.5, which is normal because they hold they hold people's money, so they have a lot of liability. So the debt to equity ratio will exceed 0.5, which is normal. So the only exception to that rule is financial companies involved in offering financial services. Next, we look at the current ratio, also used to measure management, how good the management is. We've said the current ratio should always be more than 1.5. And we've said the current ratio is obtained by dividing the current assets by the current liabilities. Then, as I explained earlier, the current assets are the money or the assets that the business expects to convert into money in the coming year. Let's just say, for example, a company has a current assets worth 100 million, then current liabilities that the business expects to pay within a year. So the current assets must always exceed the current liabilities, and the ratio must be greater than 1.5. When the ratio is greater than 1.5, it shows that the business will make profit that is enough to pay workers, for example, pay rent, and at the same time pay dividends, at the same time investing in growth. Rule number 4, always buy a company that is undervalued. If you look at the first 3 rules, identifying the first one has been identifying a company that's under good management. The other one was, if you look at all our rules that we've covered before, identifying a stock that is stable, identifying a stock with long-term prospect. The first 3 rules are geared towards identifying a good company, but you just don't buy a company because it's good. If you look at the stock market, there are many good companies which are overvalued. Their price is way above what you should be paying. So this rule number 4 states that always buy a stock that is undervalued. As a rule of thumb, I always say, when I invest in a stock, I always want to buy stocks that will give me almost the same return as the return I will get when I invest in real estate, for example. So always identify a stock that is undervalued is a stock that is highly likely to match the same amount of of money I will get back if I were to invest in real estate. So you look at I've given you a very simple method at the end of the page for those of you who can see. It's the easiest method to value a stock. There are many methods, most of them are a bit complex, but this is the easiest. It's the one I use when I want to quickly value a stock. So you take the price to earning ratio of a company, you multiply by the price to book. Those of you that can calculate the two, then multiply. Then for those of you that are unable to do that, you can just Google. Use our uncle known as Google, who knows everything. He'll give you the price to earning ratio, he will give you the price to book ratio, then you multiply the two. If they are less than 22.5, then you know that the stock is undervalued. Then you look at the rules that we've talked about, the first 3 rules, then you combine with this. If a stock passes those 4 rules, then it's most likely that it's a good stock. Last but not least, always go for dividend paying stocks. A lot of people will argue about this, as I said before, but I always want stocks that will give me both short and long-term benefits. That's why I say always go for dividend buying stock. In most cases, try to get a company that will give you a dividend of about 4-5% a year. I know it's small, but in the long term, if you are to hold a stock for, let's say, 10-20 years, then these dividends in together with the capital gain, the increase in price, will give you a very good income. Thank you for watching. I trust that when you follow those 5 rules, you'll be able to pick good stocks. Subscribe, turn on the notification button. See you in the next video. Thank you.